Welcome back to the Pro Ticker Podcast, your Thursday morning edition covering major financial magazine headlines, everyone. We've got a stack of reports here from Barron's, MarketWatch, Bloomberg, CNBC, and the Wall Street Journal. Buckle up because we're diving deep into everything from a potential Bitcoin surge to why Berkshire Hathaway had a rough day, and even what's driving up those homeowners' insurance premiums.
It's a fascinating mix of stories, and they all point to this underlying current of uncertainty in the markets right now. Lots of questions about where things are headed.
Okay, so let's start with that Berkshire Hathaway story from Barron's. Their stock took a hit down 1.6% yesterday. That's one of their worst days relative to the S&P 500 in the whole past year.
Yeah, it might not seem like a huge drop on its own, but for a company known for steady performance, it's raising eyebrows. Especially since their Class A shares actually outperformed the S&P 500 in 2024, gaining 25.5%.
So what's behind this dip? Barron's mentions a few factors. Apple, Berkshire's largest equity holding, has been down about 11% this year.
And it's not just that Apple is down, but Berkshire actually reduced their stake in Apple by 2/3 during the first 9 months of last year. Of course, Warren Buffett has said Apple would likely remain their biggest holding, but we'll have to wait for their February report to see where things stand now.
Barron's also speculates that some investors might be taking profits after Berkshire's strong performance last year. Makes sense, sell high, right?
Exactly. And then there's the broader trend of value stocks underperforming. Berkshire Hathaway is the largest value stock in the market, so this downward pressure impacts them too. The Russell 1000 Value Index, for comparison, lost about 0.6% yesterday.
Barron's does end on a somewhat optimistic note, though. They mention the strong dollar potentially helping Berkshire by cutting the value of their foreign currency debt. That could add nearly $1 billion to their bottom line.
That's a great point. Sometimes even seemingly unrelated global events can have a significant impact on a company's performance. It's all connected.
And Barron's also points to Berkshire's upcoming fourth-quarter earnings report. The FactSet consensus forecast is predicting a 16% rise in operating earnings. We'll have to see if that holds true when the report comes out in late February or early March.
That earnings report will be a key indicator of Berkshire Hathaway's health and could influence whether investors decide to buy the dip or stay cautious. Speaking of potentially big gains, let's shift gears to Bitcoin. MarketWatch reports BlackRock CEO Larry Fink now predicting that Bitcoin could reach $700,000.
Whoa, that's quite a prediction, especially coming from someone who used to be skeptical of crypto. What's changed his mind?
MarketWatch suggests Fink's newfound bullishness stems from his belief that Bitcoin could serve as a hedge against traditional currencies losing value and during times of economic or political instability. It's a digital asset not tied to any specific government or central bank.
He even mentioned a conversation he had with a sovereign wealth fund about potentially allocating 2% to 5% of their portfolio to Bitcoin. That's a huge deal if that kind of thinking catches on.
It could indeed reshape the landscape of the crypto market. But as MarketWatch reminds us, Bitcoin is notoriously volatile. Even in a bull market, 20% to 30% pullbacks are common. Investors need to be aware of that inherent risk.
Totally. And speaking of potentially risky moves, let's look at what's happening with the European Central Bank. Bloomberg is reporting that traders are betting on significant interest rate cuts by the ECB. Some are predicting a half-point cut by mid-year, potentially even a 125 basis point reduction.
That's a far cry from the quarter-point cuts predicted by policymakers at the World Economic Forum. This discrepancy highlights the disconnect between what those in power are saying and what the markets are actually anticipating.
Bloomberg suggests this flurry of speculation is partly fueled by Trump's policies and their potential impact on U.S. interest rates. The markets are trying to anticipate how global central banks will respond.
Right now, it seems the markets are split on whether the Fed will cut interest rates once or twice this year. But ING Group N.V.'s analysis, also covered in that Bloomberg piece, suggests that even a full point of cuts by the ECB might not be enough if traders start betting on more aggressive easing by the Fed.
It's like everyone is waiting to see who blinks first.
That's a great way to put it. This uncertainty is definitely creating a lot of anxiety for investors. And speaking of maneuvering on the global stage, Bloomberg also has an article about the EU's plans to invest heavily in AI, clean tech, and advanced research. They're aiming to counter the growing economic influence of the U.S. and China.
It's a bold move.
Yeah.
They're talking about establishing a research agency modeled after U.S. government entities investing in areas like AI, advanced materials, and robotics, and even building new supercomputing infrastructure for AI, calling them mega AI factories.
It seems they're taking a page out of the U.S. playbook, but aiming to scale it up even further. It'll be interesting to see how this plays out. especially considering the U.S. government's recent decision to restrict the sale of AI chips to EU members.
Do you think that move by the U.S. is part of what's driving the EU's sudden push into AI?
It's certainly possible. The global competition for technological dominance is heating up, and access to key components like AI chips is a major strategic advantage. The EU is clearly trying to avoid being left behind. But Bloomberg also points out that the EU is trying to streamline regulations, improve access to funding, and reduce energy costs to create a more attractive environment for businesses and innovation.
So it's a multi-pronged approach. You're not just trying to catch up in AI, but also trying to position themselves as a leader in the global economy.
Exactly. Speaking of trying to remain competitive, let's look at how the stock market is reacting to Trump's recent inauguration. Bloomberg reports that after some initial gains, the market seems to have paused. It closed near a record high, but U.S. futures dipped slightly.
It sounds like investors are cautiously optimistic, waiting to see how Trump's policies will actually play out. And to be honest, his first few days in office have been pretty unpredictable.
Definitely. Bloomberg quotes Mark Heifeld, the chief investment officer at UBS Global Wealth Management, who predicts near-term volatility as markets react to incoming Trump headlines. It's a wait-and-see game right now.
And some of those headlines are pretty attention-grabbing. Barron's has a piece about the Stargate project, a joint venture announced by Trump that aims to build new AI data centers in the U.S. We're talking about a massive investment of $100 billion in the first year alone, potentially reaching $500 billion over 4 years.
The scale of this project is mind-boggling, but Barron's raises a valid concern. Where's all that funding coming from?
Right, especially when you consider that Microsoft, a company known for its massive spending, is projecting capital expenditures of only $80 billion for the entire fiscal year 2025. And they have substantial free cash flow to work with, unlike this project.
Even Elon Musk, never one to shy away from expressing his opinions, chimed in calling the project's financial viability into question. He claims that SoftBank, the company supposedly handling the financing, has well under $10 billion secured.
But Barron's also mentions that OpenAI CEO Sam Altman defended the funding, suggesting Musk is misinformed, and emphasizing the potential benefits for the U.S. It's a fascinating clash of opinions.
And it highlights the tension between ambition and reality. This project could be groundbreaking, but the lack of transparency around the financials is definitely raising red flags.
Adding to the intrigue, key tech partners like Microsoft, NVIDIA, and ARM weren't even included in the equity discussions, according to Barron's. Seems they're not willing to put their own money on the line.
It suggests a potential shift in the AI landscape, with alliances forming and dissolving as the race for dominance intensifies. This Stargate project could be a catalyst for even more dramatic changes in the tech world.
It's all starting to feel like a high-stakes poker game with everyone trying to figure out each other's hand.
Absolutely. And while all of this is happening on the global stage, there are some very real consequences playing out here at home. Barron's and the Wall Street Journal both have articles about the rising cost of homeowners insurance. Premiums jumped by double digits in 2024, with an average increase of 10.4% nationwide.
Ouch, that's gotta hurt. What's driving those increases?
Well, Barron's points to a few factors. Construction costs have gone up. We're seeing more frequent and severe extreme weather events, and more people are moving to areas that are prone to natural disasters.
And the Wall Street Journal reports that natural disasters cost a whopping $417 billion globally last year, including $154 billion covered by insurers. That's a 27% increase over the 10-year average. No wonder premiums are going up.
Right, insurance companies are having to pay out more and more in claims, and they're passing those costs along to consumers. But there's another layer to this story which Barron's touches on: reinsurance.
Reinsurance, was that?
It's basically insurance for insurance companies. They buy reinsurance to protect themselves from catastrophic losses. And guess what? Reinsurance has gotten more expensive too, due to the increasing frequency and severity of natural disasters worldwide. So it's a double whammy for the insurance industry and ultimately for homeowners.
Okay, so it's not just the immediate cost of rebuilding after a disaster, but also these broader insurance trends that are pushing up premiums. Barron's actually breaks down those insurance increases by state, and some areas got hit way harder than others. Nebraska had the highest jump at 22.7%, followed by Montana, Iowa, Minnesota, Utah, and Washington, all with increases over 20%.
Barron's also highlights that the concept of a season for certain disasters like wildfires or severe storms is becoming less relevant. The Wall Street Journal gives the example of recent wildfires in the Los Angeles area in January. Even though that region is prone to wildfires, those dry conditions were very unusual for that time of year.
So climate change is definitely playing a role here, altering weather patterns and increasing the risk of these extreme events.
Unfortunately, yes. And that means we're likely to see even more premium hikes in the future.
All right, well, before we get too gloomy, let's end this segment with a story that's a bit more lighthearted. CNBC and Bloomberg both covered the contrasting fortunes of two sportswear giants, Puma and Adidas.
It's almost a Shakespearean tale of two companies. Puma's share price has plummeted almost 40% since early 2023 after they missed earnings estimates and had to push back their profitability targets.
And get this, Puma's former CEO Bjorn Gulden is now the head of Adidas. Talk about adding insult to injury.
Meanwhile, Adidas has been thriving. Their shares have more than doubled in the same period, fueled by strong demand for their retro sneakers and better than expected preliminary results.
It's a reminder that even in a competitive industry, success is not guaranteed. Leadership and strategy can make all the difference.
And sometimes a change at the top can be exactly what a company needs to turn things around.
It'll be interesting to see how this rivalry continues to play out.
It really shows how quickly the tides can turn in the business world. But speaking of shifting tides, let's circle back to the stock market. Remember that pause we talked about earlier? Well, Bloomberg has a fascinating article about how investors are looking for clues in market positioning to try and gauge whether this rally has legs.
So they're basically trying to read the tea leaves, looking for any signs of what the big players are doing.
Exactly. And Bloomberg reports that according to Deutsche Bank data, institutional investors have actually been reducing their bullish bets lately. Commodity trading advisors, for example, have cut their long stock exposure to levels we haven't seen since that market dip back in August.
That sounds like a pretty cautious move. Are they spooked by all the uncertainty surrounding Trump's policies?
That's definitely a factor. There's also the question of what the Federal Reserve will do with interest rates next. The markets are trying to anticipate those moves.
Yeah, it's a lot to process. But here's the thing. Even with all this political uncertainty, inflation has been cooling down, and fourth quarter earnings have been surprisingly strong. Bloomberg touches on this too.
That's a crucial point. It suggests that the underlying fundamentals of the economy are still relatively solid, even with all the noise and uncertainty.
So maybe there's reason to be optimistic.
Possibly. Scott Rubner, managing director at Goldman Sachs, is quoted in that Bloomberg article, and he predicts that if the market continues to climb, commodity trading advisors could pour between $15 billion and $30 billion into stocks over the next month.
Wow, that's a huge potential influx of capital.
It is, and it would definitely signal a shift in sentiment towards more bullishness.
Bloomberg also mentions that hedge funds have already started increasing their exposure to U.S. stocks, buying at the fastest pace in 10 weeks. So maybe the tide is already starting to turn.
It's a sign that some of the bigger players are feeling more confident. But it's not a full-blown stampede back into the market. There's still a sense of caution, and hedge funds are being more selective than they were last year.
Yeah, it makes sense to be strategic, especially in such a volatile environment. You don't want to get caught on the wrong side of a big swing.
Exactly. Speaking of volatility, let's lift our focus back to Europe for a moment. We've already discussed the potential for interest rate cuts by the ECB, but there's another aspect of this story that's worth exploring: the impact on the euro.
You mean how those rate cuts could cause the euro to weaken further against the dollar? Bloomberg mentioned that, right?
Yes, they did. And it's a classic example of how interest rate differentials can influence currency movements. If the ECB cuts rates while the Fed keeps rates steady or even raises them, the euro becomes less attractive to investors.
It's like a seesaw. One side goes down, the other side goes up.
That's a good analogy. And Bloomberg points out that this could create a tricky situation for the ECB. They don't want the euro to weaken too much because it would make imports more expensive and potentially fuel inflation.
So they're walking a tightrope. They need to support the economy without triggering a currency crisis.
Exactly. And all of this is happening against the backdrop of ongoing trade tensions between the U.S. and Europe. Those tariff threats from Trump are still looming.
It's a reminder that everything is connected in the global economy. What happens in one part of the world can have ripple effects everywhere else. And speaking of things that can have widespread impact, let's bring it back to something that affects us all: the rising cost of living. We've already touched on the jump in homeowners' insurance premiums, but it's worth revisiting because it's such a significant trend.
You're right. And it's not just homeowners insurance. We're seeing price increases across the board, from groceries to gas to healthcare. Barron's and the Wall Street Journal both touch on this broader theme of inflation and its impact on consumers.
Barron's focused on the homeowner's insurance piece, highlighting those double-digit premium increases in 2024. They broke it down by state, showing how some areas were hit much harder than others.
And the Wall Street Journal provided the global context, reporting that natural disasters cost over $417 billion last year. That's a huge jump from the 10-year average, and it's a major reason why insurance premiums are rising. Insurance companies are simply having to pay out more in claims.
Yeah, it makes sense, but it's still tough for homeowners who are seeing their premiums skyrocket.
It is. And as we discussed earlier, reinsurance costs are also going up, which further exacerbates the problem. It's a complex issue with no easy solutions.
So what can homeowners do? Are there any ways to mitigate these rising costs?
There are a few things homeowners can consider. Shopping around for insurance is always a good idea. Different companies have different risk assessments and pricing models, so you might be able to find a better deal.
That's a good tip. Anything else?
Increasing your deductible can also lower your premium, but you need to make sure you can afford to pay that higher deductible if you do have a claim.
Right, it's a trade-off. You're taking on more risk in exchange for a lower upfront cost.
Exactly. And there are also things you can do to reduce your risk, like installing a security system or making your home more resistant to natural disasters. Some insurance companies offer discounts for these types of improvements.
That's good to know. It sounds like being proactive and informed is key. But let's shift gears a bit and talk about some potential investment opportunities. Given everything we've discussed today, the market volatility, the interest rate speculation, the global competition in AI, what sectors or investment strategies stand out to you right now?
That's a great question, and it's one that many investors are grappling with as they try to navigate this uncertain landscape. I think it's important to approach this with a balance of opportunity and caution.
Okay, so where do we see the most potential? What sectors are looking promising?
One area that continues to hold a lot of promise is technology, particularly within the AI space. As we've discussed, the race for AI dominance is heating up, and companies at the forefront of this innovation are likely to see significant growth.
Right, we talked about the EU's plans to invest heavily in AI, and even though the Stargate project has some question marks around funding, it shows that governments around the world are recognizing the strategic importance of AI.
Exactly. It's not just a technological advancement, it's a geopolitical game changer. And for investors, it presents an opportunity to capitalize on this transformative trend.
But it's not just about picking individual companies, right? There are also ETFs and mutual funds that focus on specific sectors within AI.
Yes, that's a great way to diversify your exposure and reduce risk. You're essentially betting on the overall growth of the sector rather than putting all your eggs in one basket.
Speaking of diversification, are there any other sectors looking attractive right now?
Another area I'm keeping an eye on is healthcare, particularly companies involved in developing new treatments and therapies for age-related diseases. As the global population continues to age, the demand for these innovations is only going to increase.
That's a solid point. It's a trend that's less influenced by short-term market fluctuations and more driven by long-term demographic shifts.
Exactly. It's a relatively stable sector with a lot of growth potential, but of course, like any investment, there are risks involved.
So we've got tech and healthcare on our radar. What about areas where we should be more cautious? What are the potential pitfalls investors should watch out for?
One area where I'm feeling more cautious is consumer discretionary spending. As inflation remains elevated and interest rates continue to rise, consumers are feeling the pinch and may pull back on non-essential purchases.
That makes sense. Companies that rely heavily on consumer spending, like retailers and restaurants, could face some headwinds in this environment.
Yeah, and it's something to consider when evaluating individual companies or sectors. You want to look for businesses that are resilient and can weather economic storms.
And what about the energy sector? We haven't talked much about that today.
Energy is a complex story right now. On the one hand, we have the transition to renewable energy sources, which presents long-term growth opportunities. But on the other hand, we have the ongoing geopolitical tensions and the risk of supply disruptions, which can lead to volatility.
So it's a sector with both potential and risk.
Exactly. I think it's important to be selective and focus on companies that are well-positioned to navigate this changing landscape. Look for companies that are investing in renewables, but also have a strong track record of managing traditional energy sources.
Okay, so it sounds like the key takeaway here is to be informed, be selective, and be prepared for volatility.
Absolutely. And remember, it's always a good idea to consult with a financial advisor to create an investment strategy that aligns with your individual goals and risk tolerance. Don't try to time the market or make impulsive decisions based on headlines.
Great advice.
Yeah.
It's easy to get caught up in the hype or panic when the market is swinging wildly, but having a long-term plan is crucial.
Couldn't agree more. Investing is a marathon, not a sprint.
Well, on that note, I want to thank you for joining us today and sharing your insights. It's been a truly fascinating conversation.
It's been a pleasure, as always. I always enjoy these deep dives into the financial news.
And to our listeners, thank you for tuning in. We hope this deep dive has been informative and helpful as you navigate these complex and ever-changing markets. We'll see you all tomorrow morning with new headlines from major financials magazines.